Artificial intelligence is fundamentally changing financial crime prevention. Criminals are already using generative AI for a while to scale fraud, like creating synthetic identities, producing convincing forged documents in minutes nowadays, and running social engineering that feels more personal, more targeted and believable than ever. At the same time, financial institutions are also deploying machine learning models, artificial intelligence to improve the detection side of things, and many are now piloting AI-assisted tools that can speed up investigations and also reduce the amount of manual work that is needed. But there is a catch: using AI to fight financial crime introduces also new risks, and this can be included like model risk, governance obligations, explainability challenges, and far more regulatory scrutiny. So in this video, I will walk you through how AI is being used on both sides, what regulators are focusing on, and what you need to understand as a compliance professional. So it's time to jump into today's video. When people say AI, artificial intelligence, in the financial crime sector, they often mix together very different things. On the criminal side, is mostly about generative AI, text generation, voice cloning, deepfakes, automations, and tooling that makes scam cheaper for them, faster, and of course more scalable. On the institutional side, so in the good guys world, it's typically machine learning used for detection, things like transaction monitoring models, behavioral analytics, network analysis, risk scoring, and smarter screening. What matters is that both sides are evolving at the same time. And FATF has been explicit that AI-enabled manipulation, including deepfake, is becoming part of the threat landscape. In late 2025, FATF published a horizon scan focused specifically on AI and deepfakes, looking at risk through an AML CFT lens. In the UK, the FCA has also been building its supervisory position on artificial intelligence and machine learning for a while. A good reference point is the feedback statement FS 23.6 on artificial intelligence and machine learning, which sets out the themes regulators care about: risk, governance, accountability, and how existing rules apply. So the direction of travel is fairly clear. Adoption is happening, but expectations around control and accountabilities are also rising at the same time. As I said earlier, we're going to look at both sides, so let's start with the criminal side. First, deepfake-enabled identity abuse. AI-generated images, voice cloning, and video manipulation make impersonation easier, especially in remote onboarding context. That doesn't mean KYC is broken, but it does mean that static checks are weaker than they used to be. So this is why you are seeing stronger focus on things like liveliness detection, device intelligence, behavioral signal, and also multiple-step verification, because visual trust alone isn't enough anymore. So we need more layers to make sure that we go through efficiently and more effectively on that KYC stage. Second, higher quality documents fraud at scale. So generative tools don't just produce a fake looking document anymore. They can produce documents that look professionally formatted and consistent, which means basic visual reviews is less reliable. So the takeaway here isn't that your controls failed, is that the baseline quality of fraud has improved and your verification approach has to evolve together with that. So including digital validation where possible, metadata checks, and stronger corroboration. And third, social engineering that feels human but is also scalable. When AI really changes the game is on the personalization aspect and also in volumes. Phishing and scam scripts can now be tailored instantly in multiple languages and also adjusted in real time by those criminals. And when those scams succeed, the money often moves through ordinary accounts, which is why AML teams still see the downstream impact: victims turning into money mules, unusual third-party transfers, and fast movement of funds after that emotional pressure. The FTC reported that romance scam losses exceeded $1.1 billion in the US in its 2023 Consumer Sentinel databook. And fourth, automation in laundering workflow. But let's be precise, you'll hear people say criminals have fully autonomous learning agents. In reality, that's easy to overstate. What is clearly happening is increased automation around targeting, testing and scaling, probing onboarding weaknesses, optimizing scam flows, and moving money faster once it lands. Those items are surely in place on the criminal side. So the practical point for teams is quite simple. Expect more speed, more volumes, and fewer obvious mistakes when you see those type of financial crime activities. Now let's switch to the defensive side. First, machine learning in transaction monitoring. Rule-based monitoring produces huge alerts volume, and we've been talking about this for years now. Machine learning can help with the detection pattern that rule miss, and it can reduce the noise when implemented properly, including behavior-based and network-driven approaches. But interpretability remains a sticking point because supervisors will still ask the obvious questions. Why did the model flag this customer? Or can you explain it in plain terms if you need to review the alerts in front of a regulator? A BIS working paper on machine learning and anti-money laundering makes the same point. Performance gains are real, but transparency and interpretability remain a major barrier to broaden the acceptance of the technology. Second point on the defensive side is AI-assisted investigations. This is where many firms are currently experimenting, and tools that help investigators gather internal data, summarize customer histories, highlight key patterns, and even support the suspicious activity report drafting and submission. So the crucial line from a regulatory standpoint is that these tools are decision support, not decision replacement at this point where we are today. So human accountability doesn't move from the money laundering reporting officer or the analyst to the system. You need to remember that the human will remain responsible and central with the decision-making process. Third, risk scoring and the bias problem. If you train model on historical outcomes, you can reproduce historical bias. That's not a theoretical debate. It's an actual governance reality. And in the EU, the AI Act creates a risk-based compliance regime for certain AI users, with requirements around governance, documentation, oversight, and controls as well, of course. Number 4, screening and matching. More advanced matching can help with the transliterations and aliases, but turning and validating still matters. A smarter model can still produce terrible results if it's not calibrated, if it's not tested and monitored properly. So what should you do with all this? Start with this type of mindset. AI is now part of your risk landscape, whether you are deploying it or not. From there, the priorities are practical. Strengthen identity controls in a way that assumes better fraud inputs. Make sure that you have governance before you roll out any AI capabilities. And be very clear on who owns the model, who validates this model, what good performance means, and what happens when this model fails. Do you have a backup plan? And document everything that is done, because regulators increasingly expect evidence and not just the intent. So a useful reference point here is MAS FIT principles on fairness, ethics, accountability, and transparency, which have become widely cited government's framework for artificial intelligence in financial services. One quick note before we recap: if you want to build practical confidence in these topics, not just theory, my FinCrime Career Accelerator course is designed exactly for that. It focuses on real-world skills for AML and financial crime professionals, including how to think about new technology risk in a way that holds up in front of audit, compliance, in front of your leadership and regulators as well. So you will find the link right here and in the video description of this video. So finally, let's look at the big picture. AI is now embedded in both financial crime execution and financial crime prevention. Criminals are using it to scale impersonation, improve document fraud, and run more convincing social engineering. Institutions are using it to improve detection, reduce the volume of noise on the monitoring and detection activities, and also accelerate the investigative process. But that comes with a governance burden, so the explainability part, testing, accountability, and of course the oversight part as well. And the supervisory expectation is straightforward. If you deploy AI, you must understand it, control it, validate it, and be able to explain it as well whenever this audit will come. So this trend is structural, is not going away, and surely you will need to always keep it in the picture while you continue rolling out new technology and applications within your infrastructures. If you found this video helpful, do press the like button and subscribe for more content of this type, and maybe share even this video with someone in your team who is currently dealing with AI related risk questions. If you like more practical content on anti-money laundering, sanctions, and financial crime careers, do remember to press the bell so you will get notified when new videos are going live on my channel. So that's all for today. I'm Marco Beranzoni. Thank you for watching, and I will see you in the next one.